Hey there, Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, traders, money managers, strategists, brokers, authors, educators, learn how they've navigated the markets, understand a little bit more about their toolkit and what it's telling them about the current market environment, sort of appreciate some of their lessons learned along the way through their successful careers in the financial industry. Today we're sitting down with Gary Antonacci. Gary's the author of the book Dual Momentum Investing that has a place of honor on my recommended reading list on my website, marketmisbehavior.com. And it's often one of the first books I recommend to people trying to learn about trend following or momentum investing. His book really, we really talked through a lot of the key points that he wrote about almost 10 years ago, a little over 10 years ago now, actually. The book came out in 2014. We talked about this concept of dual momentum, which is basically combining absolute momentum, what the price action is telling you, and relative momentum, how a particular ETF or asset class is comparing to other asset classes. And by combining those two, you're able to capture a more consistent upside. You're able to minimize drawdowns, have better reward versus risk components, and overall just a much more successful strategy over time. We talked about how what inspired him to create the dual momentum model really came from some foundational experiences of his own. He actually started in the industry in 1974. Talk about a tough time to start in the financial industry, literally the low of the secular bear market of the 1970s. But like a phoenix from the ashes, Gary grew from those humble beginnings to pound out a pretty successful career in the industry. We talked about some of those early experiences, learning from Bob Farrell, who ran the technical research department at Merrill Lynch at that point. Richard Donchian, who is a legend in the technical analysis community, he created some techniques that we still use called Donchian channels, which is basically looking at a 20-day or 21-day high or low. Who's the foundation of the Richard Dennis turtle trading methodology. And again, Gary shares some of those stories from early days of learning from some of those legends in the industry. We talked about his further work with Richard Dennis, with Paul Tudor Jones, other successful money managers and hedge fund managers, and some of the ways that they were able to apply momentum investing successfully. Talk about some of the challenges of investing with momentum approaches, drawdowns that tend to be pretty common. Just the challenges of following a very simple momentum model in an environment and in an industry where complexity tends to sell better, right? People love to pitch more complex, more academic ways of approaching things. And Gary's approach is really in a lot of ways simplicity itself. Toward the end, I asked Gary why he thought momentum investing works and why the momentum factor has been so persistent. He immediately went to behavioral biases and behavioral finance, which was just music to my ears, talking about some of the behavioral reasons why investors to this day tend to make very unfortunate decisions with their capital. And as a result, momentum and really technical analysis is driven by the fact that human nature is still alive and well in 2025. This is a fun conversation with an individual whose work I've respected and followed for many years, whose book I've recommended often, and I hope you enjoyed this conversation with Gary Antonacci, author of Dual Momentum Investing. So I'm super excited to be sitting down today with Gary Antonacci. Gary's book, Dual Momentum Investing, is actually on my recommended reading list on my website, and I often point people there, Gary, when they're just getting started analyzing the market. So I'm super excited to be able to ask you some questions today. Thanks for coming on the show.
Oh, thanks for having me, David. Looking forward to chatting with you here.
No, you and I met a number of years ago in Cleveland. You spoke to a local event there, and you graciously went out to lunch with me, and I'll never forget that discussion because it was just. You had a very humble and straightforward approach of describing what I would argue is probably one of the most powerful methodologies that I've come across, and sort of new thinking on a very classic approach. So I'd love to talk a little bit as we go through the discussion, talk about dual momentum investing, help our viewers, our listeners just understand what it is, how it fits into the process, etc. Start us out at the beginning. What inspired you to sort of go through this line of research, looking at momentum and doing the work that eventually got you to this dual momentum strategy?
Well, it started when I entered the investment business in 1974. Nobody wanted to go near the stock market. So,
That's a heck
under,
of a timing for your entry into the
yeah,
financial industry, Gary.
so
Okay.
it's understandable. So I started looking for alternatives, and I looked at commodities, I looked at options, and I looked at trend following. And in fact, the most successful broker in the Merrill Lynch office I worked at, one day he pulled me aside and said, "Hey, kid, you want to see why I'm so successful?" And he pulled out his Mansfield stock charts,
Oh
showed me what
yeah.
he did. I also, saw that most trend following was used with futures markets. So I
Mm,
came across Dick Donchian's work. He uses moving average crossovers and channel breakouts, and that had an influence on me. And we had one of the best technicians in the business, Bob Farrell, working for
sure.
Merrill Lynch. So I would read his letters, and that gave me that kind of a mindset to look for alternatives. I also had a hedge fund as a client, which nobody else did, and the retail side where I worked. So I was kind of prepared for all of that. And then when I went to Harvard, got my MBA, I was managing money part time on the side with stock options. And then one of my professors, who was one of my investors, he wanted to start a commodity pool using his econometric forecasting models. So I told him I would handle the technical side. So I would look at the charts and other indicators. And I saw that I was doing better than he was. So, so we parted ways, and I figured I would start some funds of my own,
Yeah.
which I did. But I recognized smartly at the time that there were better traders than I was. So
Mm,
I made it my job to discover the best ones out there. And I hooked up with people like Paul Tudor Jones, Richard Dennis, Monroe Trout, Louis Bacon, others like that. And we managed commodity pools for about 10 years in the 1980s until we were taken over by a brokerage firm. Did very well. Investors never had a losing year. We
wow.
made really nice returns. And then I was looking what to do with my own resources after that. And I'd always been attracted to the academic research out there
Hmm.
because it tended to be more thorough. And so I stumbled across the momentum writings uh, of Jagadish and Titman and others came about in the 90s. And that had a big impact in the academic side because it flew in the face of efficient market theory. So
Yeah.
everybody started looking at the momentum, trying to disprove it, basically. And they couldn't do it. Momentum seemed to work everywhere. Uh, so people had studied it with respect to stocks, industries, foreign and
Mm,
domestic, et cetera. But nobody seemed to put all the pieces together in a way that made sense to me. So I figured I'd do my own research. I was already familiar with relative strength and with trend following, of course. So I recognized that you could put both of them together. And
mm,
relative strength is what academics call time series momentum. I refer to it as absolute momentum. And that's simply the trend of an asset itself over time. And then uh, that's absolute momentum. And then relative strength is just comparing an asset to other assets. So
mhm.
my contribution was merging the two together, and that's what dual momentum is. We look at whether the trend is positive. Uh, let's say for the U.S. stock market, that's what I focused on with my book.
Yeah.
And if it's been going up for the past year, momentum means continuity. So we would stay with the stock market. And then it was a question of knowing which stock market. So there we use relative strength to compare US to non US stocks. So I had a very simple approach in my book uh,
Yeah.
using those two elements together.
It's such a fascinating origin story. That's a great one, Gary, actually. And you've had the opportunity to work with so many, and the fact that you started working and being able to, follow the work of some legends in the technical analysis community, like Bob Farrell at Merrill Lynch, Donchian, whose Donchian channels many people use and probably don't
Mhm.
know who the man was and what he did.
Mhm.
That's super fascinating. You also mentioned, I know in your book, you'd mentioned some of the academic or some of the research that had been done. I feel like Robert Levy's paper about relative strength was
Mhm.
probably in the 1960s. And I remember you mentioning
Yeah.
that in your book. I know the first time that I was pointed to that, it struck me how powerful that was. It was a simple approach of understanding momentum, but done so many years ago in a way that is still quite relevant today. Um, I'd love for you to talk about, what is it about dual momentum, right? So as you described, you're combining absolute momentum and also relative momentum, right? So absolute momentum, what's the, price returns or the price action, and then relative momentum, how is this thing doing versus other things? Why is
Mhm.
combining the two? Why does that provide better opportunities than just focusing on pure price momentum individually?
Well, it depends what you mean by price momentum.
Yeah,
Jagadish and Tipman, they were looking at it on a cross-sectional basis where you segment the market into deciles and you say, okay, those that have been strongest tend to continue to be strong.
yeah,
So that's what people usually associate with price momentum. And that's fine, but it doesn't protect you from bear markets. So that's why
mm,
you also need a trend following component or absolute momentum to go along with it. Relative strength will take you so far. And in fact, after Levy's book came out, Mike Jensen, an academic, wrote a paper to trying to uh, discount it. And so again, academics were pretty dead set against anything other than buy and hold. So it's taken a while. It's taken a while for it to catch on. And
yeah.
what was interesting is that I think it was 9 years ago, I was invited to speak at the annual CMT convention in New York,
I remember that.
and
Yeah.
and not too many people understood what I was talking about. If a few people did, but then when I showed up at the West Coast one last month, West Coast Symposium, I spoke again, and almost everybody was talking about relative strength or momentum. So everybody has seems to have caught on now
Why do you think
to
it's
that.
taken so long? And there's still plenty of resistance out there, right? And in your book, I mean,
Yeah.
you I think attempt very well to dispel efficient markets theory and all of these sort of academic theories that should tell us that momentum investing should not work, right? I mean, it doesn't explain price momentum. Why do you feel is it more just the culture and the history of market efficiency that is dominated academia, or why do you think it's taken so long for it to become more widely adopted at this point?
Well, that's part of it. Slow diffusion of information. That's what one of the
Mm,
behavioral factors that makes momentum work. So that
mm,
also applies to people accepting something like that. There's also a psychological barrier to buying something that's going up. People are looking for bargains, right? So that's why value investing has become popular, even though there's not a lot of justification for it in terms of the results that people have gotten in the real world. So it's a combination of different things like
yeah,
that. But I'd say the majority of it is people get used to a certain mindset. They brought up in terms of strategic asset allocation or buy and hold, and they're not willing to look outside the box very
yeah.
much. And now it's starting to catch on more.
Even faced with evidence that tells them to do otherwise, right?
Yeah.
We'll keep fighting the good fight, I guess. And what's so interesting, I mean, Gary, as we go through the conversation, I mean, what a lot of the work that you did and what you put together in your book, which I'm not kidding, I have it and I've read it, I've gotten notes on it. Very very good. It really provides a broad justification for why looking at charts makes sense, right? Why should we even be paying attention to price action, because there's information embedded in there, I would say.
Mhm.
One of the challenges a lot of people have when they go into the data on sort of traditional momentum investing, think about the momentum factor that you described a little earlier, are the drawdowns, right? You tend to experience superior returns over time, but the drawdowns tend to be significant, and in a way that a lot of investors and certainly clients tend to be a little less excited about. Can you talk about how dual momentum investing specifically addresses the drawdown that can happen with a lot of momentum strategies out there?
Well, that's where the absolute momentum part comes in.
Yeah.
It's basically trend following. All momentum is based on trend, whether it's the trend of one asset against other assets or the trend of an asset itself over time. It's all autocorrelation, which is trend following. And then momentum means persistence. It's the same idea of Newton. Newton had a body in motion tends to stay in motion. And David Ricardo, the classical economist, had the right idea back in the 1800s. He said, cut your losses short and let your profits run on. Well, that's what absolute momentum does. It's designed specifically for that purpose. I have to say, though, that what I had in my book was something that was meant for the public to keep them from having these horrendous 50% plus drawdowns. But there are better ways now to go about dealing with risk, because a lot can happen month to month. Using monthly returns is good because you can go back over a lot of data. Monthly data goes back quite a ways. But to really be more adaptive, I've evolved to using daily data now. And I think that does a better job.
So one of the questions which we have to get to now is going to ask, like, what's next? Because I think the book came out like mid 2018s, right? Like 2014, 2015-ish?
2014, yeah.
Yeah, so a lot of the data is through like 2012, 2013, if I remember right. And I feel like we've had a whole lifetime of crazy market action since that point. So I was curious how your work had evolved since the book was published. Talk to me a little about, because that's one of the things that I know for a lot of technical analysts and technically oriented investors doing, what a lot of quantitative methodologies do. They keep it very simple and very consistent, which is like once a month you rebalance. But for a technical analyst, it is a nightmare to be watching something happen for weeks until you can wait until the month. So talk to me a little bit about that time compression, and why is it that daily data, give an example of how that has maybe helped you be a little more nimble, I guess?
Well, the daily data is very helpful because it can change very, very quickly. And the top traders I work with, like Paul Tudor Jones, what distinguished him especially was he could turn on a dime. He might be going in one direction and then all of a sudden he just flip over and go the other way. So you want that in your models to some extent, because markets have more turning points now. They tend to move, up and down quickly, as we just saw recently, and as we saw in 2020. So those kinds of moves are going to be challenging for monthly based approaches, and in fact for most approaches. So that's why I gravitated more towards something like the Donchian channels. Dick Donchian had two things he came up with in his newsletter. One was a 5 and 25 moving average crossover, which is a good approach. And the other is a channel breakout, where he used a 20-day channel. And that's the same approach that Richard Dennis taught to his turtle traders. Jack Dreyfus became a billionaire buying stocks that were making new all-time highs, which is a channel breakout approach. Nick Darvis came out with a book in the 1950s, similar approach. So I took a look at that as something that could replace the absolute momentum part of what I do, and I found that it's worked very well for me.
Can you talk a little bit about, in this sort of environment, particularly 2025, we're recording this mid-May of 2025. It has been, I feel like, the most unusual year of my career for sure, in terms of, volatility, which we've seen before, but just the headline risk and how quickly things are fluctuating. Can you talk a little bit about how using methodologies like this, how you approach a market that feels so, to a lot of investors, sort of non-technical, non-momentum? It just feels like events and headlines that are dominating, investors' thinking. How does this sort of work still apply in that sort of world?
Well, first of all, you have to have adaptive models, ones that
Mm,
can change quickly. For example, we got shaken out of gold when we had this spate of volatility recently, and then we were able to get back in just a couple of days later. Well, you
mm,
can't do that with a monthly model. The other thing is to use multiple approaches. So we
mm.
use mean reversion in most of our models, which when the markets have unusual moves, we'll get out, we'll take our profits, and
Yeah.
sometimes if in the other direction, if it gets battered down quickly, we'll step in, for a short-term trade.
Hmm.
So mean reversion is a complement to trend following, and the two work well together. The other thing is to have multiple markets, as well
Hmm.
as multiple models. So we have
Yeah.
models that cover stocks, bonds, gold, and digital assets. And by having all of those together, we get the portfolio effect working in our favor to reduce volatility. Uh, Ray Dalio said, if you have low correlation, good return streams, put them together. That's the holy grail of investing.
Yeah.
So we're believers in that too.
I love it. So it's diversifying not through positions necessarily, but diversifying through methodologies. Is that a fair way to describe it?
We do both.
Yeah. Okay.
We
Okay.
we a lot of what we do is channel based, but we
Yeah.
we also combine mean reversion. We have seasonality as part of it. We have uh, more traditional type trend following, like moving averages, moving average crossovers. Those
Hmm.
all enter into what we do, even though we're primarily uh, based on channel breakouts.
Yeah. Oh, it's fascinating. One of the critiques that I've heard, and maybe we've teased this out a little bit. I mean, one of the critiques about momentum investing, and certainly when you read your book, it just seems so simple. And I remember when you and I
Mhm.
first met, I said, this seems really simple, but it seems like a work. And you have a quote, a Da Vinci quote: "Simplicity is the ultimate sophistication." In your book, which I think is brilliant. Can you talk about people's resistance to use this type of methodology? And I would guess one of those is just it seems to oversimplify what people almost expect needs to be a very complicated process. Would you agree with that?
Yes, people tend to think if something is more complicated, if it's, they call it machine learning or something that sounds sophisticated, that it's better. That's not necessarily the case.
Yeah.
Um, I think what's more important is to have adequate research to validate what you're doing, because it's
Mm,
real easy to fit data now. Data is readily available. Software is out there to work with it. And you can even use AI to do the coding. But all that's going to do is fit your data in a way that may or may not, and probably will not, uh, predict the future very well. So what I like to do is still gravitate to the academic side. Every approach that we use has um, very long-term validation. 100 years or more is typical,
wow.
and that when you do that, then you can have more confidence in what you're doing. Jim Simons was a proponent of that too. He said, uh, you can be confident when you have lots and lots of data. Otherwise, not so.
Investors love to be confident with not much data, Gary. Though, so I think that's a tough hurdle for a lot of people. So, I mean, it's so fascinating. And again, I recommend your book to anyone who's willing to ask where they should look to learn about sort of trend following and momentum investing. I mean, maybe the most important question, or maybe the least important question, I'm not sure which. Why does it work, right? Why does momentum
Mm.
tend to be so persistent? And even something that you're studying in the 1950s or 60s, with some of the early works that we talked about,
Mhm.
still relevant here in 2025. What is it? Why? What's the why as to how this is so consistent, or I guess persistent in the markets?
Well, the best explanation I've found are behavioral ones. Um, people's mindset that won't change very readily.
Mm,
So people are still motivated by fear and greed to a great extent. And what happens with trends is that people underreact to information when it first comes out. There's inertia. There's kind of like prove it to me. Let's give it some time. People tend to think along those lines, or they're skeptical because they just have a mindset along different avenues than what's actually going on. So it takes some time, but if the markets are great conveyors of information, so eventually they move to where they should be, and then people will jump on in what's called the bandwagon effect or herding, and they'll accentuate those trends. So that's basically what happens is that people ignore things initially, and then later on they all get on board, and then they overextend, and then you
Yeah.
have those cycles creating and recreating themselves along the same lines.
Yeah, I feel like with all the market structure changes we've experienced, human nature still seems pretty relevant here in 2025. You know, you'd mentioned at the beginning, Gary, some of the, I mean, the again, I would argue legends in the industry that you've worked with in the technical analysis community, some money managers, hedge fund managers that, that have, I mean, don't need no introduction for a lot of people. Can you, share maybe an example of something that you learned along the way, a lesson learned early on that's helped shaped you into the investor you are today?
Oh, well, yeah, I could give you a couple examples. Richard Dennis, he had a great reputation as a floor trader.
Yep.
That's where he made most of his money. And then he went upstairs to trade, and his approach didn't work as well. We were doing business with him at that time, and it really, it was challenging for him because it was just a different way of doing things. So that's when he came up with the turtle trading methodology, and
Hmm.
then everything he did became successful again because he had a systematic approach. So
Ah,
that's one lesson that I learned is the importance of having a systematic approach, something that you can stick with and get your emotions out of the way. Paul Tudor Jones, as I mentioned, was another person I learned from watching him trade because he used multiple sources of information. He had a whole network of floor brokers who would give him information on what was going on in the marketplace, who was buying, and what size and that kind of thing, plus his own uh, way of looking at things. So the lesson I learned from him was to synthesize different sources of information together.
mm, I love it. Oh, two great examples. That's awesome, Gary. So listen, it's such a pleasure, Gary. I mean, you're just a genuinely very warm and approachable human being, and I appreciate that. And thanks for giving us some time. We're going to put a link to your book, Dual Momentum Investing, with the show so people can check it out. Is there an updated version of that book coming at some point? What's the plan here?
I'll be working on it in a few months. I'll get back to it. I will be coming out with a new book. It will be, I wouldn't call it an updated version. I'd say it's an updated version of what I'm doing, which is
Perfect.
evolved from what my book was all about.
Sure. We'll look forward to that. And once that's out, I'd love to have you back on the show and talk about some of your latest thinking and developments. But in the meantime, Gary, thanks so much. Great to see you again. Appreciate you coming on the show, and we wish you the best.
Thank you very much, Dave. Nice chatting with you.
What a great conversation. I actually met up with Gary earlier this year at the CMT conference in San Francisco. I was able to sit next to him during lunch, and he graciously accepted my offer to come on the podcast. So thanks so much, Gary, for joining us from Sacramento today. It was great to see him again. I loved his take on so many things. I mean, at the end of the day, momentum investing, his quantitative methods to analyze price and trend and momentum are really the foundation of what many of us in the technical analysis community do every trading day. We're looking at price action. We're inferring, ideas of what that means, inferring next steps based on, or projecting next steps based on our analysis of price, momentum, and trend. And I really appreciated his comments toward the end about the behavioral backing, why momentum investing works. And to be honest, the similar question would be, why does technical analysis work? And I think his answer is pretty much what I would say too. Exactly right. All comes down to human behavior, and as much as market structure has changed, as much as the dynamics of markets and time, time compression has evolved over time, human nature is still human nature. And I think the price action that you analyze on a chart reflects the fact that humans are still being human here in 2025. Great take there, and I'm super excited to learn that Gary has another book coming out. I guarantee when that's ready to go, we'll get Gary back on the podcast to update on some of his latest thinking. Hopefully, build on some of the comments he was making about rebalancing daily instead of monthly, and some of the ways he uses other models along with the simple dual momentum model that he wrote about in his book. Thanks again to Gary Antonacci joining us on the podcast today. That'll do it for today's episode. Are there other authors, educators, money managers, traders, experts that you'd like us to interview for the Market Misbehavior podcast? Please let us know wherever you're listening to the podcast or watching it. Just drop a comment with some suggestions. We're happy to pursue whoever we can to get them on the show. Thanks so much for joining us today. My name is Dave Keller with Market Misbehavior, reminding you that it's always a good time to own good charts.